Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about CANNAE Holdings Inc. quarterly report. CANNAE Holdings Inc. is a principal investment firm that has been actively investing in various sectors since its inception in 2014. The company's primary focus areas include restaurants, technology-enabled healthcare services, and financial services. In the restaurant sector, CANNAE Holdings invests in companies that offer unique dining experiences to customers. This includes investments in casual dining establishments, fine dining restaurants, and quick-service eateries. The firm also has a significant presence in the technology-enabled healthcare services space. It invests in companies that provide innovative solutions for patients, such as telemedicine platforms, medical billing software, and electronic health records management systems. In addition to these sectors, CANNAE Holdings also invests in financial services companies. This includes investments in banks, credit unions, and other financial institutions that offer a range of products and services to consumers and businesses. Overall, CANNAE Holdings' diverse investment portfolio reflects its commitment to identifying and supporting innovative businesses across various industries. CANNAE Holdings Inc. market capitalization of $1 billion is materially smaller than most of its industry peers of roughly $2 billion. CANNAE Holdings Inc. trades at a lower price-to-book ratio of 0.64 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The balance sheet appears very conservative, with liabilities representing only 25% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes, such as buybacks or dividends, rather than operational deterioration. The company has aggressively reduced its share count by more than 5%, indicating a strong shareholder-focused capital allocation approach. The company have a dividend yield of 4.46%. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline in the company can be identified through an analysis of the provided data. On the positive side, restaurant revenue has shown a significant increase from $91,900,000 to $99,100,000 in 2025. This growth is also reflected in the total revenues, which have risen from $534 million to $548 million in 2025. However, there are also signs of decline. Restaurant revenue has decreased to $91,900,000 in 2026, indicating a downward trend. The comparable store sales decline for Charlie's and 99 restaurants is also noteworthy, with Charlie's experiencing a significant drop of 12.6% and 99 restaurants declining by 2.1%. Furthermore, the guest count has decreased for both restaurants, with Charlie's seeing a substantial drop of 20.8% and 99 restaurants declining by 7.4%. The gross profit has also shown an increase from $156 million to $171 million in 2025, indicating that the company is able to maintain its profitability despite some revenue decline. Overall, these data points suggest that the primary drivers of revenue growth or decline are related to changes in restaurant revenue, comparable store sales, and guest count. The net income of the company underwent significant changes between 2025 and 2026. Initially, it decreased from -$115 million in 2025 to -$35.8 million in 2026, indicating a reduction in losses. However, upon closer examination, we see that the loss actually increased by $17.7 billion, which seems counterintuitive. A more detailed analysis reveals that this increase was due to discontinued operations, which decreased net income by $15.8 million. In terms of profit margins, there is an improvement as the net loss decreased by $79.2 million. This suggests that despite increased losses, the company's ability to manage costs and reduce expenses has led to a better financial position. The profit margin also improved significantly, changing from -10.4% to -0.19%. This indicates that the company is moving towards profitability. The improvement in profit margins can be attributed to various factors. One reason is the decrease in losses, which reduced the negative impact on the bottom line. Additionally, the company's ability to manage costs and reduce expenses has contributed to this improvement. However, it's worth noting that high inflation led to increased commodity and labor costs, which could potentially offset some of these gains. Overall, while the net income changes may seem confusing at first glance, a closer examination reveals an improvement in profit margins due to better cost management and reduced losses. The company's debt level and interest expenses have undergone significant changes over the years. Initially, on page 3, interest expenses decreased from -$3,800,000 to -$2,300,000, indicating a reduction in costs. However, this trend was short-lived as interest expenses increased significantly on page 36 from $2,300,000 to $3,800,000. Despite the fluctuations, there is a notable decrease in debt level on page 2, where total debt decreased from $329.8 million to $317.2 million. This reduction in debt was also observed in specific facilities mentioned on page 27. Furthermore, on page 48, debt level decreased by $15.9 million due to repurchases of treasury stock. However, interest expenses continued to fluctuate, increasing significantly again on page 43 from $4.3 million to $7.5 million. This indicates that while the company has made efforts to reduce its debt, it still faces significant interest expenses. Management's outlook on the company's strategy. According to management, their long-term ownership and active involvement in the company's operations are key factors in maximizing value for shareholders. This approach is evident in Alight's goal of defining the future of employee benefits and BKFC's ambition to become a leading multi-club operator of football assets. The company's strategy involves reviewing financial results for each operating segment, as seen in the CODM reviews, to assess performance and allocate resources effectively. However, management acknowledges that uncertainty and instability due to macroeconomic factors may impact financials, necessitating a balance between inflationary pressures on costs and customer value proposition. Management is confident that all anticipated cash requirements will be met through internally generated funds, which will be used for general corporate purposes such as funding future investments and conserving cash. This approach suggests a focus on sustainability and strategic growth, rather than relying on external financing sources. The company has a history of rewarding its shareholders through various means. One such way is by paying dividends, which the company has done consistently over the past 2 years. In 2025 and 2026, the company paid out significant amounts in dividends, totaling -$14,500,000. In addition to paying dividends, the company has also been actively buying back its own shares. Between 2025 and 2026, a total of 9,985,913 shares were repurchased by the company. This move is likely aimed at increasing shareholder value and reducing the number of outstanding shares in circulation. Supply chain disruptions and inventory buildup concerns the company's reliance on external suppliers and vendors raises concerns about potential supply chain disruptions. This is evident from the mention of supply chain disruptions in the report, indicating a vulnerability to external factors that can impact operations. Furthermore, the operating lease payments suggest a dependence on these external partners, which can lead to inventory buildup if not managed properly. That concludes the financial summary for CANNAE Holdings Inc. Feel free to comment below, and I will be happy to answer them when possible.